Welcome to Align Spotlight, where you meet your manager. In episode 10, we focus on the MetWest Total Return Fund, which is part of the Align Strategic Portfolio's intermediate term fixed income sleeve. In the first segment, you'll hear Align portfolio analyst James Ritzema interview generalist portfolio manager Laird Landmann on the MetWest Total Return Fund, the dynamics and philosophy behind that team's decision-making, and Laird's outlook for 2023. In the second segment, James will talk with his teammate, Align portfolio manager Benson. James and Aaron will put the earlier conversation with Laird into perspective and discuss how MetWest has been compatible with Align's long-term mindset.
It's great to have you on, Laird. As you know, MetWest Total Return has been a core part of the Align Intermediate Taxable Sleeve. The rockiness of 2022 has only made us appreciate the fund's attributes more, and I've been looking forward to sitting down with you.
It's great to be here.
Certainly fixed income investing has been challenging over the last few years. What's the traditional role of fixed income, and what have been some unique drivers recently?
Yeah, it's certainly been a really tough period. We've seen real interest rates go from negative levels to positive 1.5, something I think no one was really expecting coming in here. And traditionally, the role of fixed income has been, at least for the last 25 or so years, people thought of it as an anchor against equity exposures and higher volatility exposures. So I think 2022 was a bit of a shock when the correlations between equity and fixed income and other risk assets all turned substantially positive. And you had every asset class going down at the same time. I think as we look forward on fixed income, I think people will hopefully start to think of it more as a total return asset class now that you have real levels of interest rates that you can capture there. You have real interesting spread levels in a lot of the sectors, and there's probably the perspective for very good total return going forward. And eventually, the correlations probably go back to being a risk-off type of asset. But, as we've been through some other cycles before, it doesn't always work as a risk-off asset.
Yeah, you mentioned the total return possibility. Certainly, total return has been hard to come by. I guess what gives you more confidence as we sit here now going forward?
I think what gives us confidence is that you have, obviously, the Federal Reserve has raised rates substantially. They've taken real rates to 1.5. That level of real rates probably is incompatible with 300+% leverage ratios for the developed economies, including the United States. And so we'll probably see that come down over time, and we're probably going to see the Fed finish up here around 5 or 5.25 in terms of short rates. The market has already begun in January to anticipate the fact that the Fed will go neutral and eventually be easing. We've seen the 2-year come down, more than 50 basis points in yield. We've seen liquidity return to a lot of the markets that were starved for liquidity in the third and fourth quarters of last year. We've seen spreads begin to tighten in. So the total return is actually happening as we speak, and there's certainly prospect for interest rates to move lower, for the curve to go from being obviously very inverted to eventually moving more towards a traditional yield curve slope where you have an upward sloping yield curve and lower short rates. The market is anticipating that the Federal Reserve will be aggressively cutting rates by the end of this year. We might be a little more cautious on that, and I think for the investor, that's fine, whether it goes, you get all your total return, you get, 150, 200 basis points of rate cuts in 2023, or you just earn the yield that you have now. Many of these asset classes now yield 4, 5, 6, even 8%, and that can be a very nice total return.
Why does active management in fixed income make sense? Certainly, there's been a challenging flow environment for active fixed income managers, and there has been seemingly more inflows into passive. But why does active make sense?
We think of active making sense for two main reasons. One is fixed income revolves around one of the most important things for policymakers in the economy, which is interest rates. That means that you get a mean reverting pattern from it. So when interest rates are too high, it throws people out of work, and eventually the policymakers have to bring interest rates down. When they're too low, the opposite happens. And so if you're a very patient investor and you're long term, you can play those sort of mean reversion trends that are out there. And the same thing happens in other areas, such as the shape of the yield curve tends to mean revert. Spreads on corporate bonds, high yield bonds, structured products like mortgages tend to mean revert as well. And so if you're a long-term value investor, when the spreads are wide, you can cost average in. And as they revert back to a more normal level or even a tight level of spreads or risk premium, you can begin to sell and reduce exposure in those sectors. And then from the bottoms up perspective, there's literally millions and millions of CUSIPs out there. It's not like the stock market. There's no Jim Cramer for the bond market who can tell you about every one of the multi-million CUSIPs that are out there. And there tends to be inefficiencies created by that, where dedicated research, specialization, investing in building data bases and analytical programs that specialize in certain asset classes can yield additional return. And there tends to be inefficiencies within the fixed income markets because you have the biggest players in the world in those marketplaces. They also bring with them the biggest bureaucracies, a lot of regulation. So you think about these players, they're banks, they're insurance companies, they're government entities. They all bring with them a lot of biases and a lot of bureaucracies that leads to non-economic buying and selling of assets within fixed income. That creates inefficiency for pure total return buyers who can basically see the large sellers of certain asset classes, understand why they're happening, look at the fundamentals, and move in and buy that asset class when it's dislocated. So for those two reasons, I think active management will continue to make a lot of sense in fixed income.
We touched on the things that drive the bond prices apart from fundamentals. Did you have any other factors that you wanted to point out there?
Well, I think that the economists call it a preferred habitat. And so a lot of investors like insurance companies and banks end up having preferred habitats and they overinvest in different sectors. Then something happens that dislocates it, like a Fed cycle, and they end up being very large sellers. This happened at the end of the year just in the mutual fund space that we all know very well. There was a lot of, for the first time in a long time, tax loss selling. We saw the structured product area get hit very, very hard. We saw spreads widen out in the third and fourth quarter, 150 basis points, which is more than doubled the spreads that had been there previously. It was a great time to invest. As we flipped the calendar into the new year, literally these products tightened 100 basis points in a matter of 2 weeks in the marketplace when that sponsorship effect ended. And so those sort of things, those sort of preferred habitats, those sort of sponsorship effects are happening all the time. And I think that's what drives prices away from fundamentals. It's really the technicals. The bond market's over the counter. There's no centralized exchange. There's a little better information than there was when I started in the 80s in terms of tracking of prices where things are sold and bought. But it creates a liquidity and it creates large price swings when there's large sellers in the marketplace that far exceed the amount that the fundamentals should move for particular types of bonds.
So many investment organizations do use committees of sector heads to come up with asset allocation decisions. How are you set up differently at MetWest in making those decisions?
The two things that I'm fascinated by are the behavioral biases within investing. They're on display in fixed income all the time. You have excessively large organizations that have big committees that move slowly. They can't react to the marketplace. And we want to avoid ending up in that category. But at the same time, we also see a number of other managers where one person or a small group of people tend to dominate. And it tends to become very personality based. And these individuals are attributed special talents that they can predict the future. Our approach is always to believe that you can't predict the future. You can rely on certain phenomenons that happen repeatedly over time, like mean reversion in the fixed income markets. And we're set up with a group of generalist portfolio managers who are all equal in terms of setting strategy. We basically make sure we follow our philosophy and process across the 100 or so investment professionals at the firm, that we're always buying things on a valuation basis, whether it's a factor like interest rates or whether it's an individual bond. And we make sure the disciplines are adhered to. That is, we cost average in. We don't believe that one individual has insight and foresight to say that now is the moment to make a huge move. We acknowledge the fact that the future is unpredictable. The generalists make sure that we're cost averaging across that space. And by having a few of us, it makes sure that no one ego sort of takes over. And at the same time, it also makes sure that there's redundancy within the process. We then have specialist portfolio managers and their teams, and they're responsible for individual sectors of the marketplace. There is no one person who could cover all these different types of securities that are out there and be the best expert in the market on them. And to be better than the efficient market theory, you have to have an information edge, you have to have an experience edge. And so we try to turn these individuals and teams loose. The generalists will set risk budgets for them, but we don't interfere with their actual buying and selling day to day, as long as they adhere to the risk budgets that have been set for them. We know that they're looking at that market 24/7, and that they're the experts, and that they will find the inefficiencies using our value style. So I think that that setup works very well to avoid the two conundrums of asset management.
And then when it comes to those kind of getting those best ideas, how do you look at those best individual security ideas for portfolios along with the specialist portfolio managers?
We try to start with the generalists putting down some overall propositions about what makes good security selection. On the credit side, it really has to do with being an asset-based lender. So the credit team is steeped in the idea that whenever they look to make a selection, they are looking for companies and individual bonds that have assets tied to them that protect the downside of those securities. And similarly, on the structured product side, we're believers that you have to have better data than Wall Street and your peers. You have to build databases, and then you have to use those databases to stress test securities so that you're thinking outside the box. You're not thinking about just today's interest rate environment and volatility environment. You're thinking about all of the potential interest rate and volatility environments that could unfold. What we encourage the specialists to do is go through a process where they look at the long-term fundamentals of a security that they're considering buying. They look and see what the catalyst is to create mean reversion. That is, what will drive a low price security higher. And then finally, we're always trying to find the lowest for a given set of characteristics. We're trying to find the lowest price out there. And that wins over time because you'll generally capture more carry and more yield. And eventually the catalyst to remediate that security comes along. So if we think about it as a credit selection, we would look at it and say, here's a company perhaps that has taken on too much leverage, but they have a good fundamental business. We understand their business. Management has changed. They're now looking at deleveraging the company. That's your catalyst for improvement. The company is undervalued in the bond market because it hasn't achieved that under leverage yet, but your analysts can see a path to that. That's a security that likely would be a good candidate for the fund, in that it has both higher yields, lower prices. Those in itself are risk mitigants and obviously total return additive. And at the same time, it has catalysts to improve over time and will give us a cause to have the price go up and an exit strategy down the road for that selection.
We talked a little bit about the total return prospects for the asset class going forward, but how do you feel about the outlook for fixed income going forward?
Overall, we're very positive on the fixed income outlook in terms of total return. It's very interesting right now. I think we're at a secular inflection point. We've lived through 30 years of very, very strong disinflationary trends driven by globalization and technology. Some of those trends are staying in place, but certainly globalization is under threat and challenge right now. The fact that those trends were so strong in the last 30 years, we didn't see a Phillips curve, that is a trade-off between unemployment and inflation, really appear for the last 30 years, and now we have it again. And so I would expect that we will see over the next 10 years more volatility in fixed income. That will create more opportunity for active managers. As we look at the cycle right now, obviously we've moved from an inflationary cycle to now a disinflationary cycle. That is, inflation is coming down. The market is projecting that it will come down back to the Fed's target. I think there'll be a lot of opportunity around trading that is understanding that it'll probably be very difficult for the Fed to get inflation back down to 2% and get wage inflation to go along with it. We certainly think that there's going to be challenges at the corporate level. So there'll be most likely some dislocations yet to come in corporates. But as we look at the opportunity set today, the real opportunities are in being long duration right now, playing for a steepening in the yield curve, which is usually a very profitable strategy in terms of alpha. The corporate bond market and credit in general looks somewhat expensive to us, given that there will be a challenging, more volatile environment ahead. When we look at the structured product side, however, we've seen a lot of opportunity there, a lot of opportunity driven by unique liquidity-driven situations where there's been forced sellers in some of the AAA non-agency mortgage products that are out there, as well as very wide spreads available in the agency mortgage market because of the higher level of volatility in the marketplace. Those sectors look like they will produce very, very high total returns to us. We expect that there will be also very good trading opportunities, still arguably undervalued. A lot of opportunity in the fixed income markets, not so much in the credit side, but really on the structured product and the rates side. And so we would expect good total returns in the space in 2023 and 2024.
Thank you so much for your time today, Laird. It's been great to hear your insights.
That conversation was recorded in mid-January. Next up, you'll hear a much more recent conversation that has James switching chairs from interviewer to interviewee as he fields questions from Align portfolio manager Aaron Benson.
2022 was definitely a challenging year for stocks and bonds, and I suppose in historical context, maybe even a worse year for fixed income markets with the rapid rise in rates that we saw. So great timing, James, catching up with Laird earlier this year. And as we sit here now, close to quarter end in first quarter, what would you say are the biggest changes you've seen in the fixed income markets since back in January when we spoke with Laird?
Yeah, certainly some things have changed a little since we recorded in mid-January. I think Laird references that credit spreads are kind of tight and not attractive at that time. Credit spreads have certainly widened and are more attractive today. And part of that has been driven by, banking concerns with the failure of Silicon Valley Bank, Signature Bank, concerns for other regional banks, and Credit Suisse's forced merger with UBS. I think when Laird talks too about like Fed hiking expectations, certainly those have changed a little. I think he talks about sort of maybe a peak of 5 to 5.25. Since then, it seems like we've gone both ways. We had a stronger CPI report for January, so that expectations for the peak Fed rate was up a bunch from there, maybe 5.5 to 5.75. But more recently, with market concerns on banks, it's back in the 5% area, maybe not even get to 5%.
I've been catching a lot of podcasts lately, trying to up my podcast game a bit, but thinking on my drive in this morning must be a great time to be a market pundit.
Yeah.
with so much going on.
Last fall, I talked to Brian Whalen, one of the other generalist portfolio managers, and he was talking then about how Fed tightening would break something either in the market or the economy. Now, he put the timing of the market breaking something in the market in the fourth quarter of last year. So he was off a little bit on the timing there, but certainly we've seen some very volatile markets so far in 2023.
I guess the more things change, the more they remain the same in some ways, right?
I mean, this was supposed to illustrate how they think, right? There's short-term and long-term mean reversion is what they're thinking about. They're thinking about dollar cost averaging into positions across different market environments.
Whenever you hear about the whole active versus passive debate, it's usually referencing equities. And obviously, the struggles of the average equity manager are well documented. But I thought it was really interesting to hear from Laird addressing your questions on the topic relative to the bond markets, where the same rules may not apply. So, for you, James, when you look at the tail of the tape across fixed income, what do you see in terms of active bond managers' ability to outperform?
Yeah, certainly there are opportunities for outperformance. Fixed income markets, as Laird references, are broader with more available issues and issuers. So, on the equity side, if you think about, the decision of the manager in a growth portfolio is to own Meta and how much to own. Whereas on the fixed income side, if you looked at a big issuer like Bank of America, you can also look at, I want to be more exposed to 5-year relative to 10-year of this issuer. I would also point out that not every index is investable in fixed income. When ETFs were created to follow passive benchmarks, in certain cases, they have to alter the benchmarks to make them more investable and easier to track. You've seen that specifically in municipal bond ETFs and high yield ETFs. I think with all those kind of limitations of investing in indices, peer performance becomes more important. When we look specifically at the line intermediate strategy and the managers that we use there, MetWest, Dodge & Cox, and BlackRock Strategic Income Opportunities have certainly done well versus their benchmarks. And for peers over the long term, there is opportunities for outperformance for active management and fixed income.
You make a lot of great points, and to be honest, I don't know why that doesn't get more airtime. With the active versus passive debate and just the case for active fixed income, where there's so many different levers that a money manager can pull too.
Generally speaking, if you think about fixed income indices, does it make the most sense to have your highest weight in the most indebted companies?
James, I want to ask you about the value of a committee approach versus a star player mentality as well. And, in relation to different approaches to managing bond portfolios. And having just listened to Laird, we can obviously see where MetWest falls on that spectrum, right? And that may or may not stand in stark contrast to some of the other big names out there in the fixed income world. Firms or individuals, I'm not going to name any names, who like to capture headlines and captivate the Twitter sphere, if you will. But for you, as somebody who's covered fixed income managers for more than 10 years, I imagine you've seen it all, right? So let's take those two extremes just for the sake of argument. Committee approach versus star player. Is one always better than the other?
Really, I think either can work. It's really more so all about incentives and overcoming biases of those different approaches. So I think it's important to tie investment personnel success to the client's success that are investing in those funds. And certainly it's also just how you structure it. There can be biases with having, a specialist in a particular area that's helping to make decisions for the fund. I think of, some of the high yield portfolio managers that I talk to always think high yield is attractive, but is there a mechanism within the team to kind of overcome that and to make the right decisions for the client overall? I mean, many times there is a star PM that's really the face of a stronger, deeper team. So certainly there's PMs that, are more comfortable presenting, but they really have that strong, deep team behind them. Even with MetWest, Tad Ravel was certainly somebody who was a very vocal face of that team. He worked with many strong generalist portfolio managers that are still there, and with the specialists that are making the individual security selection. You think of also like Rick Reeder at BlackRock. He's a very vocal, but again, he's got the capabilities of BlackRock behind him are very substantial on the fixed income side, including the two other portfolio managers that are on the SIO fund with him. And you think of a historical example like Bill Gross for PIMCO. Certainly, there were a lot of strong people at PIMCO behind Bill and supporting him when he was there, and they've really more come to the fore since he departed.
Yeah, I think you hit on a lot of really great examples of this, and that's really interesting when you can have a little of both with a big name with Rick Reeder, for example, who we interviewed in a previous Alliance Spotlight episode, where he's got, that reputation for being a genius investor, really, and still he's still supported by such an incredibly deep team behind him. And the experience with PIMCO and Bill Gross, I mean, that was an eye opener, I think, for a lot of people too, just seeing the way that ended up playing out. But then at the same time, sometimes you've got somebody who flies under the radar, and they're driving all the fund's performance, and if they leave, you might as well go passive.
Yeah, certainly for multi-sector fixed income bonds, like you find in Core and Core Plus, you probably have less margin for error if you're kind of a one-trick pony, right? If you're a specialist within corporate credit and that's all that you do, then you're ignoring, 2/3 of the index that you're going against. So having capabilities on the rate side and on mortgage-backed securities and other securitized is very important.
I like your example on a high yield specialist who may always think high yield is a great investment too. I think that also just speaks to the way that we like empowering bond managers with, for a portion of the portfolio with a certain amount of flexibility to go there when it is attractive, but then position more conservatively when it's not. But for my last question, though, I'd like to touch on something that relates to some of the changes we've made in our bond allocations over the past year. And clearly our aligned investors can appreciate we take a really long-term approach with the portfolios and tend not to make a lot of frequent changes unless they're really warranted from a long-term forward-looking perspective. But last year we did make a number of changes, and that included fourth quarter of last year when we adjusted the split between short and intermediate term bond sleeves. And for portfolios with taxable fixed income, we also adjusted the weights within the sleeve to overweight MetWest as the quote unquote core option within that sleeve. So what is it about MetWest specifically that makes the fund a good option for core fixed income exposure to fill that spot in a portfolio?
Yeah, certainly MetWest has strong underlying capabilities across their specialist desks. So they have all the capabilities that you're looking for that core type of exposure. They have investment grade and mortgage-backed securities and other securitized research and trading and portfolio management capabilities. They also have strong teams within high yield and emerging market debt. Emerging market debt is something that they very rarely use in total return, but if it's a screaming opportunity, they have those capabilities as well. And then you sort of marry that with the top-down perspective and the views of the generalist portfolio managers. We're looking at the overall positioning. In most environments, this is a strong core manager that can flex a little bit into the plus types of sectors, but really does that more sparingly. I'd say, one of the things that also sets MetWest apart relative to others within that intermediate sleeve is the flexibility on duration positioning. So MetWest will actually be underweight or overweight duration relative to the ag, which is different from some managers that will tend to have a bias one way or the other. But that's all driven by those top-down perspectives of the generalist PMs and where they think markets are going over time. So as rates are increasing, they're tending to add duration, and as rates are falling, they're tending to decrease duration. And you saw that very much in 2022. They started the year short duration relative to the benchmark. As yields kept increasing, they increased that duration. They were about neutral about mid-year last year. And then by the end of the year and into this year, they've been a little bit overweight duration, which has certainly helped more recently with market volatility. But that's the kind of through the cycle investing that I think makes a lot of sense and makes it for a strong core bond option.
Great. Well, really enjoyed this discussion, James, and a great interview with Laird. I'm sure our listeners will enjoy it.
Thanks for listening to Align Spotlight. If you're a Baird client and are interested in knowing more about anything that was discussed today, please reach out to your Baird advisor.